Okay, so we're diving into Beating the Street by Peter Lynch today. This one came highly recommended, and I'm really excited to dig into his wisdom on investing, especially how it all applies to the individual investor, like yourself.
It's a classic.
It is. So we're going to break down his philosophy, look at some of his favorite strategies, and, hear some of those awesome stories from his time running the Fidelity Magellan Fund.
Yeah, that's a good place to start, actually. Because, I mean, this isn't just theory, right? This book comes from someone who was incredibly successful in the real world.
Right.
Lynch ran Magellan for 13 years. That's from 77 to 90. And guess what? It became the top performing general equity mutual fund in the whole country.
Wow.
So when he talks, people listen, and for good reason.
And the returns he generated for investors, those were just mind-blowing.
Oh, yeah. Totally life-changing for a lot of folks. Imagine this. You put $1,000 into Magellan back in 77. By the time Lynch leaves in 90, that thousand has ballooned to 28 grand. That kind of growth over that period, it just shows you the power of sticking with it, playing the long game.
No doubt about it. So why did he walk away then? I mean, he was at the top of his game.
That's the thing. It wasn't because things were going bad. It was actually the opposite. As the Dow Jones hit 2000, Lynch turned 46. And managing such a massive portfolio, it was just too much. He famously said he felt like he was spending more time with companies like Fannie Mae, Freddie Mac, and Sallie Mae.
And with his own kids. I remember that.
Yeah. And that really makes you think, right? Even at the peak of success, you got to prioritize your well-being.
Absolutely. And he had so many opportunities after leaving Magellan.
Tons. They even wanted him to start a fund called, well, you guessed it, the Lynch Fund. But he didn't want to do it. Said he didn't want to be a slave to the clock again, even with the promise of even bigger riches. He believed in letting your wealth work for you, not the other way around.
I love that. So even with all that professional success, Lynch really champions the individual investor. What's the core of his argument there?
Here's what's really empowering. Lynch believes in the amateur investor. He argues that you, by using your own knowledge, your own research into often overlooked companies, have a genuine advantage. You can actually beat Wall Street at their own game.
Really?
Yeah. He even points to the consistently solid returns of those local mutual savings banks and S&Ls. It's proof that neighborhood investing, understanding businesses in your own community, that can really pay off big time.
So it's about starting your research with what you already know, those businesses you see every day.
Exactly. But, and this is important, he's not saying everyone should become a day trader. He specifically says if you don't understand how a company works, its financials, don't buy its stock, don't invest in stuff you don't get. That's his big rule.
That makes sense. It's more about informed decision-making, not just jumping in blindly. And he talks a lot about all that market news and expert opinions, the constant noise. What's his take on that?
He calls it weekend worrying, and he's not a fan. He says, if people had actually listened to all those expert predictions over, say, the 7 years before he wrote the book, they'd have probably missed out on a ton of profitable stocks. His point is, all that macro stuff, it's a distraction from understanding individual companies. That's where the real long-term success comes from.
So it's a more focused approach. Forget the noise. Focus on the companies themselves. Now, he also talks about a decline in amateur stock picking. Why does he think that is?
Well, he's a little sad about it, actually. He compares it to, how homemade pie is disappearing and everyone's just buying the store-bought stuff. He thinks the rise of mutual funds, those managers becoming like celebrities in the 80s, it created this idea that regular people couldn't compete, like they were out of their league.
Ah, so it became intimidating.
Exactly. And the media kind of built up this image of Wall Street as this, super exclusive club. Plus, he says as fewer people dig into the details of companies, their earnings, their growth, the whole picture brokers and analysts just focus on the big institutional investors. So there's less education out there for the average person.
The experts are taking over.
Right. But here's the thing, though. While individual brokers might not focus on stock analysis as much, the big brokerage firms, they have tons of data. It's all there, ready for you if you ask. They've got these screens that can pull up lists of companies based on specific criteria, like companies that have, raised their dividends for 20 years straight.
So there are resources available if you know where to look.
Absolutely. You just got to ask the right questions.
To illustrate his points, Lynch uses some great real-world examples. Let's talk about the Food Lion investors in Salisbury, North Carolina. What happened there?
Oh, this is a perfect example of what Lynch is talking about. You've got these 88 ordinary folks in Salisbury. They each invest $100 in the local grocery chain Food Lion when it goes public back in '57. Fast forward a few decades, that initial $100 for each of them turns into, get this, $14 million.
Wow.
Every single one of them, millionaires. And all because they invested in a business they probably knew inside and out. That's the power of local knowledge.
That's incredible. And then there's that contrasting example of the St. Agnes School kids and their model portfolio, specifically IBM. What does that teach us?
This one's interesting. It shows how professional money managers can sometimes, think a little differently. So IBM stock wasn't doing so hot at the time, but the kids at St. Agnes put it in their portfolio. It's funny because a lot of Wall Street pros were doing the same thing.
They were following the experts.
Yeah, exactly. But Lynch thinks it wasn't necessarily because they thought IBM was a sure thing. It was more about, playing it safe. Fund managers, they're less likely to get in trouble for losing money on a big, well-known company like IBM. If you gamble on a smaller, lesser-known company and it tanks, well, that's on you. So there's this institutional pressure to stick with the big names, even if they're underperforming.
Makes sense. Now, Lynch keeps hammering home the importance of a long-term view and avoiding market timing. Why is that so crucial for him?
He's all about consistency and patience. He sees people who invest regularly in mutual funds without trying to time the market, doing much better than those who are always trying to jump in and out. He even talks about the Barron's Roundtable, where all these big top market experts get together. Even they fall into the trap of weekend worrying about the market, even though most of them have done pretty well over time.
So even the pros can't resist the urge to predict the market.
Nope. And then he talks about how everyone gets all doom and gloom when the market dips, like in 1990. But he says those are actually the best times to buy. That's when you can scoop up great companies at a discount. He personally bought more during those dips. He saw it as a sale.
Interesting. Okay, let's get to the age-old debate. Stocks versus bonds. What's Lynch's take on how they've performed historically and the risks involved?
This is where the data gets really interesting. Lynch is team stocks all the way. He says over a 70-year period, stocks have returned on average twice as much as bonds. That's a big difference.
But bonds are supposed to be safer.
Right, it's the common wisdom, yeah. But Lynch points out that even in those 70 years, there were 40, count them, 40 scary market drops of 10% or more. 13 of those were downright terrifying, like the crash in '29. But here's the key. The market always bounced back, even from the worst crashes. He compares stock market dips to cold weather. It might be uncomfortable, but it doesn't mean we're heading into an ice age.
So ride out the storm, basically.
Exactly. And he has a specific strategy that plays into this long-term view. He tells people to check out Moody's Handbook of Dividend Achievers. It lists companies that have consistently increased their dividends year after year. The '91 edition had 134 companies with over 20 years of consecutive dividend increases and 362 with at least 10 years. His advice: buy these stocks and hold them as long as they're on that list. What's cool about stocks is, unlike bonds, the interest rate, the dividend, can actually increase over time. Imagine that a growing income stream. He shows how a good dividend portfolio over 20 years can make you a lot of money, not just from the stock price going up, but from those ever-increasing dividends.
Wow, that's powerful. Now, even in a worst-case scenario, say the market tanks 25% overnight, how do stocks compare to bonds then?
Even then, Lynch says you're likely to do better with stocks over the long haul, as long as you don't panic and sell. He even ran the numbers for, like, a super pessimistic scenario, a 20-year recession with economic growth cut in half. And guess what? Even in that extreme case, an all-stock portfolio, even while you're taking income from it, could still match a bond investment over those 2 decades. That's how much faith he has in the long-term power of stocks.
That's really reassuring.
Yeah.
Now, how does Lynch see the overall market landscape changing over time?
He points out how in the '70s, all those big-name stocks like Polaroid, Avon, Xerox, they started struggling, not because the market crashed, but because the companies themselves weren't doing well. And on the flip side, you had these great growth companies like Merck that kept doing great, but their stock prices might have stalled if they were already overpriced. So what matters is the company itself, not just its name or reputation. He also has this interesting point about index funds. He thinks the more popular they get, the more money flows into them, the more they might actually be artificially inflating the prices of the stocks they hold.
That's a really interesting point and kind of counterintuitive. Now, for people who like the diversification and professional management that mutual funds offer, what are some of Lynch's recommendations?
He's big on diversification, not just with stocks, but with mutual funds too. Don't put all your eggs in one basket, right? He says hire multiple fund managers with different styles or invest in a few funds with different philosophies. Market conditions change, and no single style will always win. It's like having a diversified stock portfolio, but at the fund level.
So don't just own a bunch of different mutual funds. Make sure those funds are actually doing different things.
Exactly. Owning just one fund is risky. What if the manager loses their touch or their style goes out of fashion? He gives the example of how value funds were crushing it for 8 years before 87, then growth funds took over. He also says, if you're a bit more savvy, you can dig into the fund's reports, see what they're holding, and make sure it matches their stated strategy. Like you wouldn't expect to find, say, Microsoft in a value fund, right?
Right. So what specific types of funds does he recommend?
Well, to cover your bases, he says diversify across a few types: value funds, growth funds, small company funds, large company funds, dividend-focused funds, even convertible securities funds. He also says keep an eye on the big market indexes, the Dow, the S&P 500. They can give you a sense of whether to put more into emerging growth or more established companies. He really likes the T. Rowe Price New Horizons Fund. It focuses on small emerging companies. He even has this New Horizons indicator. If it's below 1.2, favor emerging growth. If it's near 2.0, maybe lean towards the S&P 500.
That's a useful tool. Now, he also talks about the challenges of managing a really large fund. What are some of the drawbacks of size?
It might seem counterintuitive, but bigger isn't always better, especially in investing. Lynch compares a huge fund to a big linebacker trying to live off those little tiny petty fours. You'd need a mountain of them just to get full, right? Same with a massive mutual fund. They can't really take meaningful positions in small, fast-growing companies, even if they have huge potential. The impact on the overall fund would be tiny, so they're often stuck with those big, slow-moving companies. He even calls it the "your fund's too big" blues.
That's a funny way to put it. He also mentions closed-end country funds. What are those, and what are the pros and cons?
Those are like a way to invest in the stock markets of specific countries. If you had a great trip to like Brazil and you think their economy is going to boom, Lynch says the best time to buy these funds is when they're out of favor. Like if they're trading at a 20–25% discount to their actual value. The idea is eventually things get better, the discount narrows, and you make money. But, he warns, foreign markets are tricky. It's harder to understand what's going on, the politics, the economics, everything. He talks about Japan in the late 80s and early 90s, how the market got super inflated, kind of like a bubble. It's a reminder that international investing can be risky.
So do your homework. Okay, let's dive into Lynch's personal approach to finding undervalued opportunities. What were some of his guiding principles?
He was all about staying on the offensive. Instead of getting stuck defending his losing picks, he was always looking for better undervalued companies. He liked businesses that were easy to understand, like those fast food chains. If it works in one place, chances are it'll work in another. It's scalable growth, you know. He invested in Taco Bell, Cracker Barrel, companies like that, and he famously regretted pulling out the flowers and watering the weeds, meaning selling his winners too soon and holding on to his losers.
That's a great analogy. And he really emphasized firsthand research, didn't he?
Big time. Even when Magellan was closed to new investors, he used that time to do tons of research. He'd visit company headquarters, go to conferences, you name it. He always said, do your own homework. Don't just read reports. Get out there and see for yourself. He even said that just talking to people, from the CEO down to the folks on the shop floor, could give you these amazing insights that you wouldn't find anywhere else.
So get out of the office and talk to people. And he seemed to like finding opportunities in those less glamorous industries, right?
Yeah, he did. Like, he loved regional banks. He thought they were often mispriced by the market. They were growing steadily, but trading at low prices compared to their earnings. So they were a steal, in his opinion. They became a big part of Magellan's portfolio. He talks about banks like Fifth Third, Meridian, KeyCorp. Each one had its own regional advantages and smart management.
So finding value where others weren't looking. Now, managing a huge fund like Magellan for that long, it must have been a ton of work. What was his work ethic like?
Intense. He'd start his day super early, like before sunrise. He'd use his commute to read earnings reports and study charts. And at the office, he was laser focused. He also really appreciated the independence he had. He could make his own decisions without people constantly second-guessing him, as long as he stayed within the fund's rules, of course. It gave him the freedom to follow his instincts and his research.
I can see how that would be important. Now, he talks about some specific investments he made, both the wins and losses. Let's start with Chrysler. What was the story there?
This is a great example of how deep research can pay off, even when everyone else is doubtful. Lynch did a ton of research on Chrysler, even talked to Lee Iacocca himself. He became convinced that Chrysler could turn things around, especially with this new minivan they were launching. He admits he was initially more excited about their sportier cars, but it was the minivan that became a smash hit. And because Wall Street had basically written Chrysler off, Magellan could get in at a great price.
So sometimes the best opportunities are the ones everyone else is ignoring. Now, he also mentions that Magellan held hundreds, sometimes over 1,000 different stocks. Were all those big positions?
Not at all. A lot of those were what he called tune-in-later investments, just small stakes to keep tabs on a company, see how they were doing. The bulk of the fund was in a much smaller group of his top picks.
A way to stay informed without going all in on everything. And as Magellan grew so huge, what were some of the challenges he faced?
The biggest one was just the sheer volume of money he was managing. It made buying and selling stocks a lot more complicated. You can't just move millions of dollars around without affecting the stock price. Even vacations had to be planned around market hours and making sure he could reach the trading desk. He jokes about choosing ski resorts based on phone reception.
Wow, that's a different world. And then there was his investment in Volvo. What was the thinking there?
He was on a trip to Europe researching companies and stumbled upon Volvo. The stock was trading at around $34 a share, and get this, the company had $34 per share in cash. So basically, you were getting the whole car business, the factories, everything for free. It was a classic value play, finding a great company trading for way less than it was worth.
That's amazing. Did he ever make any big shifts in his portfolio based on his research or his outlook on the economy?
He did. In '87, after the market had been on a tear, he started worrying that the car boom was ending, so he reduced his auto holdings. At the same time, he was bullish on financials, so he loaded up on Fannie Mae and S&Ls. It shows that even a long-term investor needs to stay flexible and adjust their strategy.
Makes sense. What about the crash of '87? Did he see that coming?
Funny enough, even though he knew the market was getting a bit overheated, he didn't predict the crash. He went into it fully invested, not much cash on hand. It just goes to show even the pros can't time the market perfectly.
You can't predict everything. He also talks about learning from his losses, right?
Right.
What were some of his big mistakes and what did he learn from them?
He admits he made his share of mistakes, like everyone does. He specifically mentions Texas Air and Bank of New England, big losses for Magellan. The key takeaway for him was knowing when to cut your losses. Don't hold on to a sinking ship just because you hope it'll turn around. He realized Bank of New England was in real trouble and started selling. Eventually, he got out completely.
Sometimes you just have to accept the loss and move on. Now, how did he use stock charts in his research?
He used charts to quickly gauge whether a big growth stock was overvalued or undervalued. He'd compare the stock price to the earnings line, his rule of thumb. Buy when the price is at or below the earnings line. Be careful when the price gets way above the earnings line. That's the danger zone.
A simple but effective way to visualize a stock's value. Now, he has that great story about visiting the Burlington Mall. What insights did he get from that?
This one's fun. He goes to the mall and he's watching people shop. He notices these new stores, like the Body Shop and the Nature Company, are packed with customers. Meanwhile, the big department stores, like Sears, they're struggling. This reminds him of a stock tip he got about the Body Shop that he'd kind of forgotten about. He even finds out that Fidelity's own librarian quit to open a Body Shop franchise. And to his surprise, he realizes Magellan had actually owned a little bit of Body Shop stock in the past, but had sold it.
Sometimes the best ideas are right under your nose.
Totally.
What about Walmart? He talks about that one a lot. What's the lesson there?
Walmart is the ultimate example of a company that just kept growing and growing. In its first decade as a public company, the stock went up 20 times. Then in the next decade, it went up another 30 times. Lynch's point is, a stock that's already gone up a lot can still keep climbing as long as the company has room to grow and they keep executing their plan. Don't get hung up on past performance or worry that you've missed the boat.
So focus on the fundamentals, not the stock price history. What about his investments in Pier 1 Imports and Supercuts?
Pier 1 was a case of buying a good company that was going through a rough patch. The stock had dropped, but Lynch saw that they had good earnings, they were cutting costs, and they were well positioned to benefit from a housing recovery. Supercuts was interesting. He basically says sometimes the stock is a buying investment than the actual product or service.
I see. So don't let personal preferences cloud your judgment. Now, he has a whole chapter about great companies and lousy industries. What makes those companies special?
These are the standouts that manage to do well even when their industry is struggling. They're usually very efficient, they're cheapskates when it comes to spending, they avoid debt like the plague, they treat their employees well, they find these little niches that no one else is paying attention to, and they often grow faster than companies in those supposedly hot industries. He mentions Green Tree Financial in the mobile home loan business, Crown Cork and Seal, a can maker, and Shaw Industries, a carpet company.
Interesting examples. So even in a tough industry, a well-run company can thrive. Now, he spends a lot of time on S&Ls, those savings and loan associations. What were his big takeaways there?
He basically divides S&Ls into three groups: the bad guys who are crooks, the greedy guys who made reckless bets, and the Jimmy Stewarts, the good guys, those well-run institutions that were pillars of their communities. He saw a big opportunity when those mutual thrifts, the ones owned by their depositors, converted to publicly traded companies. This often doubled their book value, but the stock price didn't always reflect that, as there was a chance to buy these stocks for less than their real worth. He mentions Glacier Bancorp, Germantown Savings, Sovereign Bancorp as examples. But he also stresses the importance of doing your homework. Make sure you're investing in a solid S&L, not one that's about to go belly up.
Due diligence is key. He also talked about master limited partnerships and cyclical stocks. What should investors know about those?
Master limited partnerships, or MLPs, are kind of like a hybrid. They can give you high income and potential growth. He gives the example of EQK Green Acres, a mall on Long Island. But they can be complicated, they often have a lot of debt, and they can get hit hard when the economy slows down. Then there are cyclical stocks, like car companies or commodity producers. They go up and down with the economic cycle. The trick is to buy them when they're down after a few bad years and sell them when they're up after a few good years. He says he sold autos in '87, but bought them again in '91 when they'd tanked.
So, buy low, sell high, the classic advice. He also has this intriguing idea about investing in nukes in distress. What's that all about?
This one's a bit contrarian. He's talking about utility companies that are having problems with their nuclear power plants. These companies usually go through a few phases. First, they deny there's a problem, then they scramble to fix it, which often means cutting their dividend, and then finally, hopefully, they recover. Lynch says you can sometimes make money by buying these stocks when the dividend is cut and holding on until it comes back. It's risky, but it can pay off. He gives the example of CMS Energy.
High risk, high reward.
Yeah.
He also mentions Uncle Sam's garage sale, investing in privatization. Can you explain that?
This is when the government sells off its assets, like state-owned companies. He points to the British water companies that were privatized and Conrail, the railroad company in the U.S. Sometimes these companies become more efficient and profitable after they're in private hands and their stock prices go up.
Interesting. What about Fannie Mae and restaurants? What are his thoughts on those?
Despite all the worries about interest rates, Lynch thought Fannie Mae was a pretty solid business. They could adjust their borrowing costs as rates changed, so they were fairly predictable. And restaurants, he saw them as a growth industry. People are eating out more and more, and new chains are always popping up. So even though some restaurants might fail, the industry as a whole keeps growing.
Makes sense. Now, at the end of the book, he revisits some of his stock picks from Barron's magazine. How did those turn out?
He gives updates on companies like General Host, which owned Frank's Nursery, Pier 1 Imports, CMS Energy, Sun Distributors, and Tenera. Some of these took longer to pan out than he expected. It's a reminder that patience is key. Sun Distributors was interesting. They decided to sell off their different divisions, which could unlock a lot of value. Tenera, which was involved in cleaning up hazardous waste, was still struggling, but had taken steps to improve its finances.
So it's a mixed bag, as with any investment portfolio. Finally, what are some of Lynch's key investing principles that he summarizes at the end of the book?
Okay, here are some of the big ones. First, the fact that so many pros are playing the game actually makes it easier for amateurs to find overlooked gems, if you're willing to think differently. Second, never invest in a company without understanding its business. Third, a company's stock price might not reflect its success in the short term, but in the long term, it almost always does, so be patient. Fourth, market dips are normal, and they're buying opportunities. Fifth, anyone can learn to invest, but it takes guts to handle the ups and downs. Sixth, there's always something to worry about. Ignore the noise and focus on the companies. Seventh, doing your research is non-negotiable. It's like playing poker without looking at your cards. Eighth, time is your friend with good companies, your enemy with options. Ninth, if you don't have time to research individual stocks, diversify with a mix of mutual funds and avoid switching between them too often. 10th, consider international investing to tap into faster-growing economies. And lastly, in the long run, well-chosen stocks will beat bonds and money market accounts hands down. But bad stocks, well, they might not even beat cash under your mattress.
Those are some great takeaways. Any final thoughts from Lynch about where to find opportunities?
He mentions that at the time he was looking at California in '93, much like he'd looked at New England in '90. The idea was to find good companies in depressed areas where their stocks might be unfairly punished. And he stresses again that you have to understand the individual company, its specific situation. He gives the example of Sun Distributors selling off its divisions. Don't just rely on broad trends, look at the details.
So it all comes back to doing your homework. Well, there you have it, a deep dive into Beating the Street by Peter Lynch. What stood out to you? The power of local investing, the resilience of the market, the importance of understanding the businesses you invest in. We encourage you to take another look at your own investing approach and see how you can apply Lynch's principles. Okay, so we're diving into Beating the Street by Peter Lynch today. This one came highly recommended, and I'm really excited to dig into his wisdom on investing, especially how it all applies to the individual investor, like yourself.
It's a classic.
It is. So we're going to break down his philosophy, look at some of his favorite strategies, and, hear some of those awesome stories from his time running the Fidelity Magellan Fund.
Yeah, that's a good place to start, actually. Because, this isn't just theory, right? This book comes from someone who was incredibly successful in the real world.
Right.
Lynch ran Magellan for 13 years. That's from 77 to 90. And guess what? It became the top performing general equity mutual fund in the whole country.
Wow.
So when he talks, people listen, and for good reason.
And the returns he generated for investors, those were just mind-blowing.
Oh, yeah. Totally life-changing for a lot of folks. Imagine this. You put $1,000 into Magellan back in 77. By the time Lynch leaves in 90, that 1,000 has ballooned to 28 grand. That kind of growth over that period, it just shows you the power of sticking with it, playing the long game.
No doubt about it. So why did he walk away then? He was at the top of his game.
That's the thing. It wasn't because things were going bad. It was actually the opposite. As the Dow Jones hit 2000, Lynch turned 46. And managing such a massive portfolio, it was just too much. He famously said he felt like he was spending more time with companies like Fannie Mae, Freddie Mac, and Sallie Mae.
And with his own kids. I remember that.
Yeah. And that really makes you think, right? Even at the peak of success, you got to prioritize your well-being.
Absolutely. And he had so many opportunities after leaving Magellan.
Tons. They even wanted him to start a fund called, well, you guessed it, the Lynch Fund. But he didn't want to do it. Said he didn't want to be a slave to the clock again, even with the promise of even bigger riches. He believed in letting your wealth work for you, not the other way around.
I love that. So even with